Well, good afternoon and welcome to Supreme Lending. Our program today, Trump, Tariffs, Taxes, and Trends, is a conversation about what's currently happening in Washington, how we expect that might impact all of us as Americans, and just as importantly, how these changes will likely impact our industry and the clients that we serve. Supreme Lending is not politically biased or motivated. Know that. Our mission at Supreme, our highest priority is to serve. The title of today's program simply reflects the current happenings that will likely impact all of us as Americans and certainly all of our clients. This is the 8th presidential transition that's taken place since I cast my first vote. It was Reagan, then it was Bush Sr., Clinton, Bush Jr., Obama, Trump, Biden, and now Trump for the second time. Reflecting on these changes, transitions in my own life, typically when there's been a transition, both domestic and foreign policy, it would shift by northeast to the right, 5 degrees, or north by northwest to the left, about 5 degrees. That's not what's happening right now in Washington, and I think all of us understand that. Whether you're for what's happening or not, matters not. The people that you serve every single day care that you understand it and that you can help them get through it, making the biggest decisions of their life. We're seeing changes that are closer to a significant restructuring right in front of us of domestic and foreign policy for the company that we all call America. And I want to remind all of us here today that the single biggest investment that most Americans, our clients, will ever make in their entire lifetime is buying a home. That's right. The single biggest investment. And we're their guide. That's what we do. We're guiding them on the investment journey. We may not see it that way, getting caught up in transactions, but that's exactly what's going on. To be the best guides, we need to know more. The more you know as a guide, the better you can do as service professionals who know more to offer more value, which means better guidance for our clients. Based on this presidential transition in Washington, I'd argue there's never been a time, maybe never again in our life, where knowing more will have mattered more for all of our customers. That's exactly why we invited you here today, and it's exactly why we invited our special guest here today as well. Doug Duncan, he's invested his entire career as an economist. He's been recognized. I mean, he was on Bloomberg News, 100 most influential people in real estate. That's just one of his many, many awards that he won as an economist. He's celebrated all over the place for doing the work that he's done. He's also dedicated his entire life, not just as an economist, but in housing. So there's no better expert in the country, specifically on the industry that all of us care about so much. So we got the best guy here today. I'd ask all of you to join me in welcoming Doug Duncan.
Thank you. Thank you.
Here are our objectives today, because all of you are really successful people. You always have goals and objectives. So here they are. We want to educate you on economic terms in general and specific terms that are in the news. We want to offer you Doug's best guess on the impacts of some of these new policies that are taking place in Washington and how he thinks they're going to play out over time. Offer you a perspective on where the economy is right now, because it's changing just like Washington right in front of us, and where it's going. And finally, a housing forecast for 2025. I hope that meets the criteria for why you would have come today. All right, so let's start out with some basic information. I think everyone in this room should know these things. That's why we have them. Doug, the challenge, okay, 30 seconds or less. All right. So let's start with question number 1. What is GDP?
Gross domestic product. And that doesn't mean it's gross. It's just an accumulation of all the value that's created in the economy, the assessment of all the value created. There's a counterpart called GDI, gross domestic income, which is measuring that same economy by the income each of those actions produces. Over time, they should be the same.
So it's like the cash register, the American cash register, right? Everything that's sold, all the goods that are sold, everything is sold, it's the tally, right?
Yep.
All right. So
Right.
good. And then we measure that for purposes of growth. All right, so let's go to question number 2 that I think all the folks in the room should know. You'll hear this an awful lot this year. What is monetary policy?
It's the process of managing the value of the currency at the same time as maximizing employment within the economy. So the central bank uses interest rate policy to affect both economic activity levels and also employment.
Right. So, wow, another 30 seconds or less. So when you hear about the Fed, the Federal Reserve, think monetary policy because that's what's happening. They're trying to keep inflation under 2% and they're trying to maximize employment. Those are the balancing acts that they work to every single day. And it's important because you'll hear about monetary policy a lot this year because the Fed is going to be in the news again this year. And as we've talked about in the past, when the Fed's in the news a lot, something ain't good. All right, that's out of the way. All right.
Hey.
Got some basic ideas. Let's dive into the deep end and talk about TRUMP.
I've heard of him.
I decided not to say his name, okay? And again, there's no politics in this. I don't want you to think that. We're here just simply to try to get you better informed. So what's changed the most, or what is potentially going to change the most based on January 20th, the inauguration of a new president? What's happening right now?
There, for the first time, other than in the 2016 term, there's a serious discussion about significant increases in tariffs. Now, there was sort of a minor version of that in his first term, but this is cast at a much higher level. And that is different than the last 50 years, which has seen the global decline in tariffs. Actually, I was looking at some data just a few minutes ago. The peak of average net tariffs occurred in 1932. And since then, year over year, with a couple of small reversals, we have seen a decline in tariffs for that entire time period. That's a dramatic shift in fiscal policy.
So like it hasn't been that big of a deal over the last 50 years. And we were at a low point, and now we're talking about a radically different idea taking place.
Absolutely.
All right. So we hear a lot of discussion about the debt and our deficit now. In your opinion, how's it impacting interest rates today, and how could it impact the overall, lifestyle we all have, the economy, and interest rates going forward?
Well, the U.S. government is viewed as the world's most likely to repay their debts.
They've got a high credit score.
They have a high credit score. And this is raising questions about how sustainable that credit score is. So the level of deficits that we have been running for the last 2 or 3 years is the same level of deficits as a share of GDP, which we defined earlier, that we were running at the peak of World War II. And we're not throwing all of our resources at a world war. I mean, there certainly are some wars going on, but it's not the foundational structure of the U.S. economy. So this is a radical departure from that history. So the question in global investors, partly conditioned on what they think about the tariff issue, will be, do they need to add any additional risk premium into treasury rates because of some threat to our willingness to repay over time?
In our business every day, the business that I'm in, we price customers based on credit scores, the ability to repay, whether or not they can actually do that. The more likely based on history and the credit score, the lower the cost. So think about it in the exact same terms. As a nation, when we're out, we have the largest debt pool in the world by a long shot at just under 37 trillion. So just think about it in that terms. The lower the credit score in our business, the higher the cost of money, the better the credit score. And we've always had a high credit score as a nation. And there's some questions right now from some very bright people about the size of it at this point.
Yeah, I don't think it's a big risk at the moment, but part of what global observers are looking at is what's the approach that's taken, and will the approach that's taken over time reduce the size of that deficit and the overall debt?
Yeah. So let's stay on that. We've heard, all of you have, about this Doge thing, right? DOGE, which is the Department of Government Efficiency. They're making an effort, and again, there's no emotion in this, but they're making an effort. It was installed to reduce expenses at the federal government level, to impair, shrink the deficit. That's what the objective is. With defense spending, Social Security, Medicare, and Medicare, it makes up about 70% of all the dollars that we spend in Washington. At this point, those are not on the board for cuts. So that leaves about 30%. Is it possible for us to make a material impact on the deficit that we're running without affecting military, Social Security, Medicaid, and Medicare?
And you have to throw onto that the interest on the debt.
Oh, the interest on the debt.
And if you get to that, it's probably around 80% of the budget. So if you're talking about attempting to balance that budget on 20% of the total budget, it's unlikely. In fact, I'm certain that can't happen. So there does have to be some addressing of the entitlements at some point, and that's part of what the global investors will have to assess is the U.S. going to get serious about what are really unsustainable commitments that we've made? That they don't have to be eliminated. The terms can be adjusted. And the last time we addressed Social Security was in the Reagan administration, when it was addressed by, over an extended period of time, raising the rate at which you would be eligible to get benefits. And the one thing to note about Social Security is when it was first initiated, the year at which you could take the first set of benefits was the average life expectancy of the U.S. population. It was about 64, 65.
So they made a commitment to give you money and expected you wouldn't be able to take it.
Because it was designed as an old age poverty tool, not as a savings and retirement fund. That was not its purpose. But over the years, all kinds of additional benefits have been added without adjusting the actuarial nature of it. And so now, within a decade, we will be paying out of general revenues for Social Security. The Social Security reserve is actually just treasuries that are dedicated to the benefits of the Social Security fund.
So if Doge was successful and 20% is left over that they're working on today, we had a $1.8 trillion deficit last year. 20% is $360 billion. And we cut half of all of those expenses. We're saving $180 billion, and we're still running a deficit of $1.6 trillion, which is not going to please the world marketplace when it comes to our long-term viability of repaying.
Well, and one of the things that we do have going for us, in spite of that inappropriate structure of our federal fisc, is that there's not really a better place in the world to put your money. So as long as that holds, we're okay.
So let's get after the conversation of tariffs and trade. You just said, and they're out in the open now. They're every day. It's the news. They're on, they're off. They're this much, they're that much. There's responses taking place. It's like a battle out there, a fight out there with partners that we trade with on the regular. So if they've been around for a long time, albeit at a lower level, what's going on right now? I mean, what's happening with these tariffs? And as you think about it, maybe we'll start with this. What is a tariff? How about that? Start there.
A tariff is a tax, and it will either be paid by the person who is wanting to import whatever that product or service is. Either they will pay that, or the provider of that will decide to take a smaller profit margin and subsidize the sale of that to offset the tariff. But at its root, it's simply a tax. One of the things that's interesting is that I read the New York Times and the Wall Street Journal, and both of them write somewhat similar stories about tariffs, which is interesting because they don't agree on a lot of things.
Mostly anything.
They may have different reasons why they take that position, but it is interesting that history of 50 years of declining tariffs shows up in both the publications.
So what's the best case with tariffs right now in terms of outcomes, and what's the alternative case?
Well, what you're asking for is what is the objective of the tariffs?
Yes.
And a bunch of people have been asking that, and it's the right question to ask. Why? So in the case of some of the specifics that are some of the specific countries, we're asking them for certain things. So you think of Canada and Mexico as they're our neighbors. Actually, if you add Canada, Mexico, and China, that's 43% of all U.S. imports are those three countries. So you can see why they are high on the tariff target rates. So what's been said is we'll put 25% tariff on goods from your country if you don't stop immigration, or if we don't. So that's a specific objective. So if that objective was achieved, does that mean no change in tariffs? That's what's implied. I don't know whether that's what would actually happen. But there are, in the cases of Mexico and Canada, he has stated specific objectives that he would like to achieve. And if they were to achieve them, then we would see whether or not the tariff charge would go away.
What about with China?
With China, I would say there's one that you have to go back to the 2016 election. And if you look at the electoral vote in 2016 and overlay that over the geographies in which manufacturing jobs were lost, they're a perfect fit. So more than anyone else in the country, he observed that this was a major issue in the population, and he was right. It was. It got him elected president. So part of his objective with China is to bring manufacturing jobs back. So that's part of the reason for the tariffs. Another piece of it is national security questions, whether we should sell them some of the technology tools that would enable them to push forward their defense systems at a faster pace than if they had to develop themselves. So there's a couple of objectives, and he may have other objectives beyond that. Those are a couple of important ones.
So what we do know at this point is they're relatively new on the scene at the levels that we're talking about today. The other countries, I think it's fair to say, don't like them and don't like what's happening right now.
Yeah, and there's two or three things that can happen that can make them ineffective. One is counter tariffs.
Yeah.
So if you put a tariff on us, we're going to put a tariff on you. And so you saw that probably most recently in the news with, I think it was Ontario province said, well, if you're going to put a 25% tariff on autos, we'll put a 25% tariff on electricity that you get from us. So that's one way in which they can actually create significant damage. A second way is exchange rates can change. So one of the objectives of the Trump economic plan is to lower the value of the dollar, to reduce the dollar. That's to encourage exports from the U.S. If the dollar is strong, it's expensive for foreign buyers
To buy from us. Yeah.
to buy from us. So it aligns with this attempt to move manufacturing back to the U.S. Now, we've had conversations before about U.S. manufacturing. One of the things that's not well understood is that the real inflation-adjusted value of manufacturing in the United States last year was the highest it's ever been. The problem is, and it's not actually a problem, the reason that occurs is because the productivity gains in manufacturing in the United States have been twice the level of productivity gains in any other sector of our economy. And so we're doing more and more with fewer and fewer people. But it is demonstrably not true that we don't manufacture anything. We manufacture a lot of very high value kind of products that are shipped all around the world.
We've just gotten so productive that
Very productive.
there's not as much job growth in that
And
sectors.
the incomes earned by those who are in manufacturing have increased dramatically because their productivity has increased and the value of the product that they've produced has increased.
Let's talk taxes, okay? Because we did have that one of the items on our list. Many of you may or may not know this, but in 2017, there was um, a tax change, last material tax change in our country. And those are basically going away as of this year.
Mhm.
So they either need to be extended or those taxes will go back to what they were prior to that.
Right.
It represented significant cuts for people, individuals, and for corporations. So there's a lot to consider with the idea that those tax rates would go back to where they were in 17. Do you expect, should they be extended, and do you expect they will?
I expect they will. I think if the other part of the Trump economic plan is to work, I think they must. Because if they expire, that's an increase in taxation, which is going to reduce the level of demand in the economy. And if you partner that with a raise of taxes through tariffs, it's a ticket for slowing economic activity. So I think, and he has said that's a stated objective. So I think it will be achieved, not without a bunch of wrangling. There's a bunch of contentious issues, and that's the reason it hasn't moved further and faster. I think a lot of people expected that the tax issue would be dealt with first, but instead he's gone with tariffs and immigration as the primary things out of the box. Partly, perhaps, because of the difficulty of getting an agreement with both the House and the Senate on exactly what to extend or whether to add or subtract anything from the bill.
But suffice to say, politicians in general, right, left, they don't like to raise taxes. So
They do
this will
not.
be one of those where right now we're kicking the can down the road with spending, continuing at resolution, right? So no one really wants to be the party that raised taxes.
There's a famous Southern politician that said, "Don't tax you, don't tax me, tax the fellow behind the tree."
All right, let's talk about current economic conditions because we know what happened leaving the fourth quarter of last year on GDP, which we talked about earlier. Um, but let's talk about what's going on. Before we start that, for all of you to understand, GDP, there are three spenders principally in the American economy that make up the spending that goes on in our country for GDP purposes. There's the federal government. We've talked about that, right? One of the propellers. Imagine the U.S. economy is a big boat. One of the propellers on the back of the boat is the U.S. government. A second propeller is businesses. They obviously hire people. They make capital investments, build buildings, build factories, et cetera, which puts people to work. The third and biggest propeller on the boat is the consumer, the American consumer. So government employment and government spending, in your opinion, is going
Down.
down.
The government employment is going to go down.
Government employment is going down.
Yeah. So if you look at the employment characteristics of the U.S. economy, there are 2 million roughly direct employees of the federal government, not military. But during the Clinton administration, which was referenced earlier, Al Gore led an effort to reduce the size of government, but the way that it was reduced was lots of activities were outsourced to private contractors. So if you add in the private contractors that are dependent on government contracts as part of that employment, you're talking somewhere like 7 to 10 million people. So if you were to lay off even a third of that, now that would start to have an impact on both local economies in those places where those workers are concentrated, but more broadly in the employment statistics within the economy.
But just as we think about the big picture of the economy, one of the propellers is slowing down right now. That would be the government propeller, where it's been full throttle. It's now going to be slowing down both in terms of employment. And if Doge has its way, they'll be spending less money ultimately. I want to show you a chart. The Atlanta Federal Reserve Bank, there's 12 in America. The Atlanta Reserve Bank, like most of the reserve banks, takes information in from businesses in its region and then feeds it to the Fed chair, because they are all talking about what's going to happen with the economy. A couple of weeks ago, the Atlanta Federal Reserve had GDP for the first quarter guesstimated at 1.8% growth, a little bit off from the fourth quarter, 1.8. I looked at this number the other day, and I thought first I saw a graph that just was that it was fake news. It wasn't. They projected off at 2.8% in the first quarter. Now, as we talk, that number probably changes because there's more inputs coming.
It changes over the course of the month. They update each data element as it comes out, and they will adjust things that get revised from previous periods. So it does change up until the date that is the end of that forecast period. So I expect it will not remain as far in the negative.
All right. So we've talked about a little bumpy. We've talked about the possibility of recession. The Fed left things on hold. What does the Fed need to see? They left the year, by the way, just so you all know, they had gotten into a rate cutting cycle, and it's not like them to get in a cycle where they start cutting and then they stop. But they did last year. They made 3 cuts. There was a go forward forecast, what they call the dot plot, when they started cutting, that had them cutting 6, 7, 8 times over a 12-month period of time. When they got to year end, they said, we're done for the moment. They kind of went on hold. Actually, 1 cut in the next 12 months, which would have been, surprising just 3 or 4 months before that.
Right.
So what do they need to see to get back into a cycle of reducing interest rates?
Well, they have to believe a couple of things. One is that there will be a sustained slowdown in economic activity that might need monetary policy support. And they also need to see inflation continue its downtrend to its 2% target. Now, if let's suppose that the slowdown proceeds at a faster pace and actually becomes a downturn, then they're going to have to weigh the question of, will inflation continue to come down during that environment in a period when tariffs are being discussed and where the tax cuts have not been put in place to support the incursions of tariffs into trade, and therefore not bring on stagflation, a period when growth is very slow and inflation doesn't come down. That's kind of the mix of things they're going to have to decide around, and there's no perfect guide to that. We haven't seen anything like that since the 1970s, and we didn't have the tariff issue in the 1970s.
All right. So we've covered TRUMP. We've covered tariffs, taxes, and some overall economic trends that are going on. You're doing a great job. Give it up for Doug. No, so all right, let's talk specifically about what all of you do every day, what I do every day, housing and housing finance. How about that? All right, let's move on to that because I thought it was helpful. Every one of your buyers and sellers are watching social, listening to what's going on in the market. All of these things we just talked about are on their minds. There's 3 things that really drive housing. There's demographics. And so you want to know about the movement of people, right? And we happen to, by the way, we're incredibly blessed here in Atlanta, Georgia, and in the Southeast in general, because people are moving to our place versus moving out of our place. And there are places around the country today where the ingress, egress, there's net loss of people. And for a business like ours, where we need people to come in to buy a roof, it's a kind of big deal to have net demographic benefit. And we've got that here. So check the box. Good news. The second thing is employment. And employment, if you look at it on a historical perspective today at 4.1%, it's about as good as it's ever been in terms of the employment marketplace. That can always change. But those 2 boxes, and those are 2 pretty critical boxes to drive this stock called housing, they're in place. The third leg is affordability.
Mm-hmm. So this level of unaffordability is not unprecedented, but it's pretty close to the precedent.
Yeah.
You go back to the late 70s and early 80s, affordability was actually worse. There was housing activity. There were sales and purchases of homes, but at a much lower level than in subsequent periods. So it's not unprecedented, but it is tough.
All right, so let's talk last 5 years in housing. In 40 years that I've been in this industry, the last 5 have represented the best and then the worst in a 5-year period. 2019, this is just some data for all of you, was kind of our last quote unquote normal year in housing because it was BC, before COVID. So we didn't have the impact of all of the impact of COVID, which has put us in a roller coaster moment. You'll see that here just in a second. You just lived it. But in 2019, there were 5.34 million homes sold. It was kind of a normal year based on demographics and based on all the things we just talked about. That was kind of a normal year. And then COVID happened. And the fascinating part of it is we went from 3.5% to like 14% on unemployment in a month. One would have thought, if y'all remember, in May of 2020, we shut down the economy, go home, there's COVID, and unemployment went through the roof. And everyone thought that we actually were going to see a big downturn in the economy and a big downturn in housing. But that's not what took place. In 2020, 21, and 22, halfway through 22, we had housing sales at record paces, which is fascinating. And you'll speak about that in just a second. And then the second half of 22, 23, and 24, we kind of reversed that trend. So we had the best, and then in the last 2 years, we've had the worst. In fact, 5.34 million, the last normal year of housing sales in 2019. This past year, home sales were about 4 million. We haven't had a number of 4 million in home sales since 1995, and we have 80 million more people in America today. So you all lived through it. It's fascinating that it is that volatile, because historically our industry doesn't have that kind of volatility to it. You were talking to me earlier today about the 2020, 21, 22 phenomenon that affected 23 and 24. Tell us about that.
I would put a box around the 8 quarters from the third quarter of 2020 through the second quarter of 2022. So in that time period, because of monetary policy and fiscal policy, if you remember, there was a federal bill that was passed that gave direct monetary contributions to people's checking account. I'll come back to that in a minute. And also the PPP program, which for businesses allowed them to keep workers on salary. So you have a demand push from fiscal policy, and you have an easing of affordability from monetary policy, and you did like an extra 2 years worth of volume in that 8-quarter time period, which brought forward in time business you would be doing today.
So the other thing that's terribly different for the first time in 40 years that I've seen is we never saw home price increases. I've never seen them, and the data tells us that they've never been as robust as 20, 21, 22, 23, 24. You add it all together, it's 47% over a 4-year period of time, which if you're a homeowner, you're like, hot dog, and then you got your tax bill. Then you're like, I didn't know that. We had, I didn't think tax bills were going to go up, but the value of the asset went up. So, of course, the taxes are going up as well. Homeowners insurance, exactly the same thing's taking place. So when you think about affordability, it used to be once upon a time the price of the home, the cost of the money. Well, the price of the home went up 47%. The cost of the money went up to a 10, 15-year high of 7% plus over the last couple of years, impacting affordability. Oh, and then taxes have gone up, and homeowners insurance has gone up. So the combination of all those has made affordability more challenging today than almost at any time in history for all of those reasons. That's what all of us are facing. Demand actually still exists for housing. Let's have you walk us through the forecast for 25, 26 for housing sales.
So reasonably, to your point about the existing home sales number being at the low since 1995, with the addition of 80 million additional population in the U.S., it would be quite surprising if you did not see at least some increase in new and existing home sales. Now, the supply of new homes is over 1 million.
There's 9 months of inventory right now, or 1 million new homes that are finished, complete for sale.
And the number of houses for sale which have not been started, which is an estimate of future demand, is the highest it's ever been. But you have to reconcile those two numbers. 9 months available for sale today, and the sort of the suggestion that they think there's going to be significant demand for additional ones. Yet, I think it's the affordability issue. The houses that were built and completed are not the same price point as the people who would be entry-level buyers today. And you get to that by looking at a 1,400 square foot house used to be considered a starter home. Only 7% of houses built last year were 1,400 square feet or less. So that's a place where you run into the affordability challenge. And now here's where tariffs come in. If we establish the tariffs against Canada, we import a lot of lumber from Canada that will raise the price of building a new home, and put us right back into the affordability.
Well, the good news is you have 1 million to sell right now. So get out there and sell the 1 million that are out there. The inventory numbers are actually, they were at all-time lows during the record run that we had just a couple of years ago. We're back up now 3.5 plus on resales, and having new homes inventory of almost 9 months today, it kind of leans towards potentially that we're going to start seeing prices come down some.
Yeah, that's the forecast suggests that. I think the forecast over the next 2 years goes from something like about 6% in 2024 to about 3% or a little more than 3% in 2025, and about less than 2% in 2026. I would argue there's a very good chance that the national average will actually be a decline
Going down.
in late 25 and into 26.
So the next 8 quarters, it's not radically higher quarter to quarter, but it is indeed growing every quarter.
The Fannie Mae forecast is established on what is known. So what we know today is that the tax bill will not it expires at the end of 2025. So the forecast actually has in it the expiration of that tax bill. Until we know what the form of any additional legislation is going to be, we do not put it into the model because we can't know. We do, however, run scenarios. So that's one thing that you could, if you wanted, you could ask, do you have scenarios of what happens if it doesn't? And there are some of those things that get produced.
The good news is we have 8 quarters, at least in the forecast, of increasing in housing sales. So going the right direction in the next 8 quarters. Yeah, that's good news. We had in the last couple of weeks more what we would call initial demand credit pulls than we've had in like 3 years. I mean, the phones have been ringing. I don't know if all of you have experienced that, but the demand has really kicked up at this point right now. And that is just an accumulative effect. We've had lower sales in the last couple of years than would be normal. And those people haven't decided that not buying a home or wanting to own a home is the deal. They just haven't been able to afford necessarily. There was an inventory and they haven't been able to afford.
Yeah, that's not just here. I was on the phone before we started with a lady that owns an appraisal management company in California, and she said that while last month was slow, she's now getting calls this month. Things are picking up. So it's not just here.
So one of the questions I wanted to ask you have two, and then we're done. So if I'm a realtor or a loan officer and my customer's out and they're in the marketplace and they're looking, they don't have a house yet, so they're exposed to the interest rate marketplace. They want to know what's going on. What are like 1 or 2 things that you would tell them, hey, pay attention to this economic number? You know, of course, they can call us and we'll give them an update on the direction of interest rates. But if I'm a realtor, what should I pay attention to? 1 or 2 economic data points that come out regularly that would tell me the direction, generally speaking, for interest rates.
Well, we talked earlier about employment. That's the number one. And many local universities and things produce local estimates of what's going on in the employment market and in local incomes. Those are things I would pay attention to, and I would have them. I know in Cape Coral, Florida, where I am, Florida Gulf Coast University puts out a monthly data point on a bunch of things. They have airport landings, all kinds of details that give you a sense of the economic health of the market. But critical. Is employment growing, or is it flat, or is it not growing? That's a really important.
And nationally, for all of you, the first Friday of every month at 8:30, the nation reports its non-farm payrolls numbers. So
We call that an Economist cocktail party.
you guys get there for that. You're there, right? Everybody wants to go to that party, right?
Absolutely.
So that's a number that I would tell you I have historically tracked, because the direction of that number this past couple of weeks, it was supposed to be 170,000 jobs. It was 150. There's actually a lot of people that were expecting it to be even lower than that because of all the things that we talked
And they're
about going on
expecting next month
to be even lower.
yeah,
Right.
because of
So
the Doge.
that number continues to decline. That would be net positive for interest rates, meaning that would lean towards telling you that rates are likely to start going down. What else?
That's right.
What would be one other thing you'd have us look at?
The interest rates, obviously, those two things are closely tied.
CPI?
Yeah, there's two different measures. The Fed follows the purchase consumption expenditure measure, the core of that. It's because it's more dynamic in the measurement of what I was talking about earlier, relative price changes. So it actually looks at how do people respond to relative price changes. So it will probably be the better measure at picking
More
up
important going
tariffs.
based on tariffs.
Yeah.
So that inflation number, today's inflation number came out. It was actually better than expected. And that is a telltale sign that rates are more likely to go lower than they would be going higher. And we just went through a couple of years cycle where inflation was going up, so rates would be following them.
Yeah, and the other interest rate to follow is the 10-year Treasury.
10-year
Because typically people think of mortgage rates being spreads over the 10-year Treasury. So you've seen a wild ride of the 10-year drop 50 basis points in a month, and now it's back up 20 basis points. I don't know what it did today, but that's just an example of the volatility that the business sector is facing.
And by the way, everything we talked about early on, the 10-year Treasury or even mortgage rates, if you think about it, in the last 30 days has come down about 40 to 50 basis points in a 30. That's like unprecedented. In 30 days for things to move that quickly in the interest rate market. And that is because of what's going on in Washington right now, the uncertainty that's taken place. The only thing that's holding rates up a bit now is tariffs and the idea that we just don't really know what we don't know yet about it, how that's going to turn out.
That's right, and it's a risk premium, but it also is impacted by the expectation of prepayment.
All right, last question. Ready?
Sure.
Yeah.
I'm from Washington.
Is it a good time to buy a home?
You know, I gave this answer 30 years ago, and then every year since then. If you have a family or household budget, that's the most important clause, because every lender is going to ask you things that come right out of that budget. And at today's interest rates, the price you want to pay for the house and how much money you'd have to borrow, that payment fits your budget today, then it's a good time to buy a house. Because if rates go up, you've locked in a better rate than you would have gotten if you waited. If rates go down, you can refinance. You have that option. So if you are a homeowner, that's the advice for a homeowner. If you decide I'm going to wait and guess where interest rates are going to, now you become a speculator. Some people can afford to be speculators, others cannot. So that's why the clause about the budget. When you walk in the door, if you have a family budget, when you walk in the door to a lender, they're going to ask you all the questions that come from that budget. So you've already told them you're an educated consumer. You know your capability and the value that you provide to them. And it allows you to take that from lender to lender to get them to negotiate to get you the best deal.
Hey, Doug, thanks for your insights today, and thanks for being here, sharing your views on the president and on tariffs and taxes, just general trends in the economy. As real estate professionals, our job is to understand all of these things and to be able to offer value as service professionals to our customers. And you gave us great information today to be able to do just that. So we thank you for being here. We really do.
Thank you.
Give it up.